Richard, thanks very much for coming in.
Pleasure.
So, core German equities insanely cheap, are they? Are you increasing your exposure to Germany?
Yeah, we're overweight. You make me sound like an out-and-out bull. It's funny. It's not normally the reaction I get. We're actually quite gloomy about the global economy.
All right.
And gloomy about equities overall. We are just, and we've been very, very, very vocal about buying longer end of core government bond markets all of this year. So we've been massively overweight. We've just brought that down a bit. We just think that the relative value is in the longer end of corporate bond markets.
Yes, at the longer end, because, well, the shorter end is just, the yields are too low.
Well, it's partly that, but it's also to do with the fact that if the only yield you get on the government side is at the long end of the curve, of course. But we want the credit spread duration. We want that long end. And if we are, quite clearly, in a Japanese situation, you're going to start looking at spreads not in percentage point terms, not in basis point terms, but in the extra % of yield you get. That's what you saw in Japan in the 1990s, is actually what you saw in the US after the 1930s as well.
And it's interesting you say that we made you sound bullish when actually you're quite gloomy about the outlook. Because actually, I mean, it looks like it's not just equities in Germany that you like. Within equities, you've also pushed Brazil to slightly overweight from underweight, and India as well is up to neutral from underweight. So,
yes.
So why is that?
Well, that's more of a relative sort of play. Brazil...
So it's short-term trade?
Well, no, it's simply that we've been massively underweight both of those all year. Now, the problem for Brazil is that it has some real inflation problems. But the fall in commodity prices, the slowdown in global growth, means that you're going to become less worried about those inflationary markets that before you were much more worried about.
Because right now in India, for example, there's been concern about inflation hurting demand and
Absolutely
corporate
right.
earnings.
Yes, that's exactly right. But so essentially the way to think about all of this is that if you go back to the 1990s or the 1980s, whenever the Fed whacked up rates, the emerging world fell apart. So the emerging world is actually now benefiting from the problems, at least to an extent, from an inflation perspective, from the problems in the developed world.
But we saw Brazil going in the opposite direction, if you like, and cutting interest rates. Inflation is still very high. So if we do see emerging markets start to ease monetary policy, does that mean that inflation could become more of a risk further down the line?
I suspect it's much less of a risk overall than it was. Now, you saw the China numbers out this morning. They fell a bit, 6.2% year on year, but some of the core prices are still rising there. That said, lower growth globally is going to take some of those inflationary pressures off. And it's a relative expectations game here. If you were more worried about inflation before, quite clearly you've got to be almost by definition less worried about it now.
So I know that you're very excited about corporate debt on the long end.
Hugely excited.
Yes, I can see it in your eyes. So can you then talk to me about possible scenarios where those investments wouldn't deliver?
Right. So the way to think about it in a portfolio context is this: that you would be bullish about corporate debt only if you thought that long-term risk-free rates were going to stay on the floor and perhaps even fall a bit. You would not be bullish about long-term corporate debt if the crisis got worse. In other words, if spreads did what they did in 2008, 2009, you're not paid for that risk. However, from a portfolio context, you hedge that risk by underweighting equities. So in effect, you've immunized your portfolio. What we've done is we've brought down the duration of the government portfolio to less than benchmark. We've increased the duration, the spread duration and credit, and we've hedged that credit spread by underweighting equities. So essentially what that means is that you probably don't want to be, at these sorts of yields, a lender to governments. You do want to be a lender to corporates whose balance sheets are in far better nick because of the profits they've been reeling in over the last couple of years or so. But the way to think about it in very conceptual terms is you want to be a creditor, not an owner.
Okay, fair enough. So we've talked a little bit about some of your positions. Actually, I just want to talk about the Fed, because, of course, we're hearing from Ben Bernanke just yesterday in his speech. And, Richard, just some of your views in terms of what you're expecting. You're saying the Fed will ease monetary policy again. You say it's unlikely it'll even plump for that they will plump for an even bigger round of asset purchases. And you liken the financial markets to a drug addict, which requires ever more drugs to get any sort of high. So, I mean, I'm just I'm just wondering, if we do get, I mean, Ben Bernanke did indicate that the central bank will look at measures to boost growth, possibly some further stimulus down the line, and that could involve exchanging short-term securities for longer-dated securities. So we keep hearing about QE with a twist.
I think that's the most likely.
Yeah.
So listen, QE2 didn't work. Well, it worked to the extent that the counterfactual might have been much worse growth. But it didn't work to the extent that it boosted long-term sustainable growth. And you can see that by the GDP numbers. The problem with QE as well is that it works by depressing the exchange rate. If you depress the exchange rate, essentially commodity prices go up, which is what we saw, and actually household incomes are crimped. Why is that important? Well, it means that actually it all comes out in the wash. Well,
so I'm just wondering, what could that mean then for investors staying long in duration in terms of bonds? I suppose we're talking about government bonds here. Well, that's not going to be a safe bet anymore.
Here's the point. So if they go down this sort of operation twist, that presumably means that the longer end of the bond market, all things equal, is supported, right? So now you have 30-year bonds in the US yielding 3.3%. 30-year bonds, by the way, have returned you 25% this year. Now, if you look at 3.3%, now you are far more paid, or paid far more, if I put it in natural English, to go and buy the long end of the corporate debt market. In other words, you play that duration not in governments, but in corporates. That's the way we're thinking about it. Now, there's a liquidity question, there's a liquidity risk, but I'm being paid to take that liquidity risk.
All right, OK, Richard Cookson, there you go. Thanks very much.